Are you aware that you pay a capital gains if you sell a tax on the sale of your home, your primary home? So let's say you bought your home for 100,000 and you sell it for 300,000. That's a 200,000 capital gain. Do you know you have to pay tax on that potentially? And do you know, even more interesting, is that is up for debate right now as to being eliminated. So today we're going to talk about the elimination of capital gains tax on the sale of your primary residence. Let me bring in my co-host, Tony Shore. Tony, welcome to the show. I know you're a big fan of taxes, and talking about eliminating them is going to make you upset, but I love elimination of taxes. So let's talk about the elimination of the capital gains tax on your primary residence. Have you heard about this?
No, actually, I haven't. I mean, I have heard that there is capital gains if you sell your house, if you bought it for, I don't know, if you sell it at a gain, you do have to pay money on the difference, right?
Yeah. Well,
Like it's an
let's go through
investment.
quickly what the current rules are for those that
Yeah,
don't know, and then we'll talk about how this is being potentially eliminated,
yeah,
which
it
would be
should be.
exciting, I think.
Yeah.
Well, so currently the tax, it's an exclusion. So if you buy a stock and sell it, and we're going to talk long term, if you sell it over a year later, you have long term capital gains, and there's a separate tax rate for that.
Yep.
0%, 15%, or 20%, depending on your income. The same goes if you sell a piece of property. But the house has its own special exclusion in the United
Right.
States currently, and that is gains of 250,000 or less are excluded. So you get to write off or not pay tax on the first 250,000 of gains on your primary residence, and that's 500,000 for a couple.
Oh, nice.
And that amount was set in 1997. It was originally 1986, and the last update was in 97. The problem is it's starting to creep up on us because back in 97, a $250,000 gain isn't as much today. You know, if you have a $250,000 gain on a house, it's not like, whoa, clutching the pearls. That's crazy. Now, it's not, it's a very common thing. Um, so what is this exclusion though, and who qualifies, and what does it mean? Because you can't buy rental property or flip houses and not pay tax on gains. It's got to be your primary residence. And there's what's known as the 2 and 5 rule. Two, number two in the number 5 rule. You must have owned the home for at least 2 years of the past 5 before you sold it. You can move out, wait 3 years and sell it if you owned it for 2 years prior to of those past 5, and also you have to have used it as your primary residence for at least 2 of those 5 years. So there's 2 parts. You have to own it, and you have to actually live in it for 2 out of the 5 years.
So if I bought a house and let's say I paid 300,000 for it, and then I somehow was able to sell it within 2 years and make 300,000 on it. And that's within 2 years. It was my primary residence, but I lived there less than 2 years. I would have to pay capital gains on the profit.
Full profit. Exactly. I literally just went through this with a client. They
Huh.
bought a house that they thought was going to be their, retirement home, but they found another home nearby that they wanted, and they actually flipped it. And they had a significant gain, believe it or not. 2022, 2023, the house went up a
Sure.
lot.
Yeah.
And so it didn't go up 500,000, but it went up, I think, over 200,000. And so the couple was like, well, if we move now, then and sell it, we're going to get hit with capital gains on all of that. And so what they did is they waited the 2-year mark and then sold it.
Sure.
So it was only an extra like 90 days they had to wait timing wise, but it was worth it to them to fall into this 2 and 5 year rule.
Sure.
There are some exceptions to this. One of those is active duty. So you could suspend the 2 and 5 for up to 10 years if you're stationed at least 50 miles from home, or you are living in government housing. And
Sure.
there's a link to the IRS rule
That
on
makes
that if you're
sense.
interested.
I'm glad there's
Yeah.
exception for military if you're active duty. Yeah.
Right, because that's not, well, I couldn't live there. I was deployed.
Yeah.
Um, Also, only one of the spouses needs to meet the ownership test to be eligible for the exemption, but both have to meet the use test. So if you own the house in your name and then you get married and a year later you sell the house and your new spouse moved in with you, um, they wouldn't meet the ownership test or the use test. But if they lived there for 2 years and they never owned it, it's in your name, then that's okay. So only one has to own, but both have to meet the use test.
Sure.
So here's the issue I have with it, Tony. And if you think about it, a lot of people bought their houses in the 70s, say, and maybe they paid 50,000 for it. And now it's not unreasonable to say it could be worth 800, 900,000,
Sure.
right? I mean,
even if it's just worth 500,000, that's a huge gain.
Right, 10x. But it's not uncommon. And then it's more so for people that bought their houses in 2000 or even 2010. The house pricing has gone up tremendously. So what happens is you pay tax on the gains, which I don't like, but it is what it is. But you also have to, it just increases your taxes. It also impacts your Social Security taxation. So if you're on Social Security, you're 62 or 60 and you're a widow, and you sell and you have a capital gain, that counts as income. So that raises the taxation that you pay on your Social Security income. It also impacts Aunt Irma, meaning the government's going to come after you and raise your Medicare premium if you now fall above the Medicare limits. You might be paying more every month for Medicare Part B and Part D for drugs. And it also impacts the Affordable Care Act subsidies for those that aren't on Medicare. So you have this artificially inflated income, even though it's just a capital gain. So it's got, it's there, and I don't like it. So,
So
what are you gonna
capital
do?
gains, even if it's designated as capital gains, if you're, let's say, in retirement, it's going to count as taxable income overall.
Yes.
That affects things like IRMA. Does it really?
Yes.
Does IRMA look at capital gains
Yeah. So say you're a
and Social
retiree,
Security taxation? Is
right?
that part of capital gains are
That
part of that formula?
it's part of your adjusted gross income, which is what the formula based. And now Social Security's got
Sure.
its own separate formula. But let's talk about the IRMA. I recently dealt with this. I had a client who, well, say like a Roth conversion that counts that rate that could raise your IRMA, but they sold a rental property they had, and they made a good capital gain on it. It was, I think, over 200,000 capital gain on their rental property. They rented it for years. And normally they have their rental income, and they're okay. They stay below the IRMA limit. But they sold it. They had a $200,000 gain. Boom. Now the government's like, hey, you had big income this year. You're paying a higher premium for Medicare for the next year. And they can appeal that. And a year later, they won't have that on their taxes. But when it comes to a capital gain, there's no way you can appeal it. It just doesn't work that way on something like that. So yeah, the exclusion also continues for 2 years for widows and widowers. This is a question I get a lot about this. What if my wife and I own the house, and then my wife dies, and now I lose the $250,000 exclusion that she was getting? So now I only get 250 because I'm a single person. Yes, but they give you 2 years, so you can
Ah,
extend that. So if you lose a spouse, you might consider, if you're planning to move, try and do it within that 2-year window to get that extra 250,000.
sure.
But once that 2 years passes, now you lose that 250. It's like, geez, again, another reason why we should get rid of it. So speaking of that, enter enter the No Tax on Home Sales Act.
Wow.
Have you heard of this one?
Nope. Never heard of this.
Congresswoman Marjorie Taylor Greene, July
She's been
10th,
in the news a lot
2025.
lately.
Right. I know how much you love her. She introduced this bill to eliminate the capital gains tax on home sales. There's a link for those watching on YouTube. You can read the 2-page press release about the bill. But there is the actual bill on there saying, basically, I want to eliminate taxes on the capital gains tax on home sales. Here's the
Just
quote.
period across the board.
Primary homes. This
Yeah,
exclusion
primary
rate
homes.
ratio, right? So here's the quote from the House bill. It's not law yet, but when asked about this, Trump in July of 2025 said, "We're looking at it." He also said in the next breath something along the lines of, "If the Treasury Secretary, if the Fed would lower rates, we wouldn't have to worry about all this." But he's not, So now we have to think about it. So
Yeah, and they
here's the
held
quote.
rates again. They refused
Right,
another session, Fed session,
right,
and they came out yesterday and said we're not lowering rates again.
which
Trump's not
may
going to be
give
happy.
momentum to Trump to push Congress to make this Marjorie Taylor Greene bill a reality. So here's the quote from this bill. Quote, to amend the Internal Revenue Code of 1986 to eliminate the dollar limitations on the exclusion of gain from sales of principal residences and for other purposes. So it wants to eliminate the exclusion limit, the cap, which is currently 500,000 for a couple. So who's going to be impacted if this goes through? That's the multiple. That's the big question.
Yeah.
Because I like it because it's just elimination of taxes and I'm just, me. But if you look at it from just a broad perspective, this is going to cost the government money, right? Less tax revenue
Yeah.
means it's
So you're
costing the
you're going
government
to
money, which,
increase the budget deficit, which is already in the trillions. You're going to
right,
add to
right.
that, but who benefits from that elimination? If it's already 500,000, so only the people who make more than $500,000 in capital gains on the sale of a house, this will help.
Correct.
And do
Which
those
is
people need
becoming,
the help?
see, now here we go. I knew you'd pick up on what I'm putting down. I'm going to say I really like the idea of eliminating this tax. But what I want to do is I want to share my screen um, for some statistics on this. Here is the Federal Reserve Bank of St. Louis. The median sales prices of houses sold for the U.S. Okay, from 1963 to today. Can you see this chart, Tony?
Yes, looks good.
Okay. Sorry for the viewers. I mean, for the listeners on Spotify or iTunes. But I'm looking at this chart and it's basically going straight up, right? Not straight
Yeah.
up, but it looks really like there's no
Mhm.
slowing down. We had
Right.
the '08 crisis here, and then boom, look at what we've done since 2020.
I know,
Quite
it's
the increase. So
crazy.
if we
Yeah.
look at 1970, let's say 1970, the average sale price was $23,000 in the United States. 1970, 23,000. And today it's 410,000.
Yeah.
So now you might say, well, that's not 500,000. And when they made the rule in 1997, the average home sale price was 150 around 144.
Mhm.
So, to have a $144,000 house have a $500,000 gain, you really have to hit a home run, which has happened. So I think this does impact a lot more people than normal than it was originally intended. So I did a quick calculation using the CPI from the Bureau of Labor Statistics, the CPI calculator. I said, what was $500,000 in 1997 worth today? What is 500,000 when they set that limit for a couple in 1997? If we just use the CPI inflation number, that is a little over 1 million today. So if you say $500,000 gain is enough to write off, why? We've had inflation. 500,000 today in 97 isn't 500,000 today. It's double that.
Because it doesn't help the majority of, I don't think it helps the majority of Americans or the middle class. I thought, okay, if I'm going to sell my house and make $250,000, I don't want to have to pay capital gains. But if somebody sells a house and makes over 500,000, if they only have to pay capital gains on the amount over 500,000, not that big a deal, is it?
It's very similar to the Social Security taxation discussion we had on that previous
Sure.
show,
Yeah.
which was if we eliminate taxes on Social Security, who's really going to benefit? It's really the higher income earner that benefits because the lower income earner doesn't pay taxes on their Social Security anyway.
Mhm.
So you're making the same case for the taxation of the primary residence. However, the case can also be made that people are not selling their homes. They're trapped. You know how people don't want to buy a new house because their mortgage rate is 2.5%. And they're
Right.
like, if I buy a new house, I got to pay 6%. Why would
Yeah.
I do that? Right. So they feel trapped in their home. The same logic can be said about someone that's got a capital gain on their primary home. They don't want to sell it because they're going to have to pay taxes on the gain. And this could be a huge issue, especially for a widow or a widower. They lose their spouse. They stuck around for 5 years. They're like, now this house is a little too big for me. I raised my family in it. It's 5 bedrooms. I want to move down to Florida because Minnesota's taxing me too much. So what do I do? My 5 bedroom house is worth $1 million. I spent 200,000 to buy it in 1980s. Now I'm a single woman. Well, $1 million is a nice price to pay. That's you did you didn't deserve that. That's a lot. That's a big capital gain. You shouldn't be complaining. Cry me a river. You made $800,000. Yeah, but if I have to pay capital gains tax on 500,000, what is that? 20%? That's 100K that I have to pay tax just for what? Downsizing? So you could see how it can impact people. The story isn't as crazy as it once was in the 1990s of having a $500,000 gain,
So you're
especially when you
telling what
factor
you're
in losing a spouse.
So what I'm learning from this, from everything you've told me, what I gather is that Marjorie Taylor Greene probably has a really expensive home that she's wanting to sell. She got
You
cheap.
know,
It's been in her family since the 60s, and now it's
right,
worth millions. So she
right.
proposed this bill. Is that is that what we should assume?
She's just trying to help mom and pop sell the house. You know, um, the point you can go either way with it, Tony. I see the value of this revenue for the government being discounted, and really the only real people that get a true benefit from it are above average, right?
Right,
Middle class to above.
right.
Whereas the person that's house isn't even worth 500,000, how are they going to benefit from this?
Right.
But I do see how people can be trapped. I do see how people can pay a tax on something that they weren't really thinking of. So I think the important message is if you're thinking about downsizing, moving, really understand how this capital gains tax works.
Sure.
Don't be surprised by it. It used to be a rich person's problem if you looked at it from a non-inflation adjusted situation. But I don't know. Housing prices have gotten out of control. And so I don't, and it's getting tougher to buy houses, right? So
Yeah.
this theoretically could get the turnover a little bit more if you said, yeah, you don't have to pay tax on it. People might be more than willing to sell. I think it should have been pegged to inflation, the same way I think that the Social Security taxation level should have been pegged to inflation. The same reason why I think a $255 death benefit set in the 1940s for Social Security should have been pegged to inflation.
Yeah.
It's the same reason. So you set this tax law, and it makes sense at the time you're looking at the situation. But if you don't add an inflation factor in it, you're gonna run into this. Eventually, you're
Yeah.
gonna have to, you can only kick the can so much. So yes, Marjorie Taylor Greene probably has her or her constituents that have a huge capital gain that they're trying to
I
figure
was
out how to
just
get away with.
teasing. She might not, but yeah, I don't think this is going to hit a lot of the middle class, which is what I like to see laws is that it really take the tax burden off the middle, even upper middle class. I think there are a lot of middle class people whose homes aren't going to sell for more than $500,000 today. So as your chart showed, so that's the
Right.
average.
Yet that's average, that's median,
Yeah,
whatever. So what about
true.
the super expensive states of California, Massachusetts, New York?
Sure.
A
Yeah, that's true.
$500,000 house is a starter home, right?
Yeah,
So,
if that. Yeah.
right? And if you double your house price in 15 years, which is
Which it
not
will in
unreasonable,
California, yeah, or New
right?
York, yeah.
Like exactly. So they're the ones that are getting hit.
Yeah,
And
that's a
and
good
they're the
point.
ones that want to flee the taxes, other taxes in the state. So they flee, they get hit on the way out. I agree with you though. This isn't going to hit enough people to get the pitchforks and torches out.
Yeah, but I like it
I think
does address I agree with you, if they just build in when they make these laws, tie it to inflation, even the crappy inflation rates that the government uses, which
right.
don't
Or the
reflect
like the tax tables.
they don't reflect the when gas and eggs and healthcare goes up by 20%.
Right.
The inflation rate the government gives out, inflation right now is at 2 point whatever it is, 5 or 6.
All right. So then add that to our standard deduction,
Yeah,
add that to our tax tables,
agreed.
right? And add it to every
They
other
should.
tax we pay.
Yeah,
And I think that's probably what will happen here. I
yeah.
don't see the elimination of it. I would love it. I would love to see the elimination of it.
Mhm.
Would it favor the wealthier states with the bigger houses? Yes.
Sure.
But it's just one less tax, and I'm all
Yeah,
for it. However, I think what's most likely going to happen is some sort of compromise where they say, yeah, let's adjust the cap. Let's either put an inflation situation on it going forward, or let's upwardly adjust it based on the 97 number and then inflation from there. That's what I think will happen. But something should happen. But you never
yeah,
know. With Trump in the office, with the Federal Reserve rates not budging, he might just get an itch and say, let's pass this thing and ram it down like we've
yeah.
had in the past. And, I'd be okay with it. I don't like that process, but any elimination of taxes is good for me, I think. I like it. Helps my clients out
And I'm
anyway.
sure, yeah, most of our listeners would agree,
Yeah.
especially those heading into retirement or in retirement. Any amount they can save, especially in taxes, is going to be good. So,
I think the single person, the 250,000, it's not unreasonable to make $250,000 capital gain on a home
right,
anymore.
right,
It's
yeah,
so that number by itself has to be adjusted upwardly or
agreed,
eliminated.
yeah,
I'll go either way, Tony, but
yeah,
status quo, nope.
agreed.
Nope. Wow. So you just agreed with Marjorie Taylor Greene. We're gonna end it on that, Tony. I'm not gonna let you even comment. Everyone, thanks for another good show. We'll catch everyone next
All
week.
matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.